Welcome back to the Neuro Finance Masterclass. This is day 65 of our 365 Days to Financial Freedom series. Today, we're tackling an absolutely crucial theme: safe havens, gold versus risk assets. Now, yesterday, we learned how to read the VIX fear radar, but today, I want you to picture this intense scenario. That fear radar suddenly screams panic. The markets flash red. The whales, those massive institutional players, start aggressively dumping their tech stocks left and right. Now, they don't just freeze up, and they certainly aren't panic selling to hide cash under a mattress. No, they execute a highly calculated maneuver. Which brings us to the ultimate question for this explainer. Where do the whales actually go when the VIX screams panic? Because when that fear radar spikes, the pros don't just exit the game. Instead, they execute a highly strategic flight to safety to actively protect their wealth. They go hunting for a sanctuary. All right, let's dive into Section 1, the flight to safety. In the professional financial world, you absolutely must have a safe harbor to dock your ship when the hurricane inevitably hits. A safe haven is exactly that, the ultimate shelter for your wealth during times of market panic. It's the very core of that flight to safety we just mentioned. Think of it as your indestructible fortress. It's the asset class that ruthlessly protects your net worth while the rest of the world is bleeding out of their paper assets. It is literally where you go to survive the storm. Moving right along to Section 2, risk on versus risk off. Now, what's really fascinating is the stark contrast in human psychology here. As a strategic architect, you have to instantly recognize these two distinct global market moods. On one side, we have risk on. Investors are feeling incredibly confident, right? They're happily buying up tech stocks, crypto, small cap companies. Gold usually just sits flat here. But then, the switch violently flips to risk off. Suddenly, investors are terrified. They dump everything and frantically run into gold, government bonds, and the US dollar. You're looking at the absolute difference between confident greed and terrified panic buying. And that leads us to the core philosophy of a master builder. The architect doesn't try to predict the weather, they simply adjust their sails. When everyone's greedy, when the VIX is low and the sun is shining, we hold our gold and safe havens quietly. We aren't trying to time the rain, we're just waiting for the panic to hit, knowing our sails are already perfectly set to weather it. Which brings us to Section 3, gold. The ancient standard. 5,000 years. For 5 millennia, gold has survived the financial collapse of literally every single historical empire. Think about that for a second. It has a track record that absolutely nothing else can touch. It acts as this phenomenal store of value because it has zero counterparty risk, and crucially, it is completely immune to central bank money printing. A government simply cannot print physical gold into existence. So the crucial point boils down to these core attributes. No counterparty risk, cannot be printed, survives collapsing empires, and acts as your ultimate insurance policy. Listen, physical gold is not going to make you insanely rich overnight. That's not its job. Its job is to ensure you never go bankrupt when inflation spikes out of control or, heaven forbid, a war breaks out. When that risk-off switch flips, physical gold is your unyielding shield. All right, let's pivot to Section 4, Bitcoin, the volatile challenger. We operate in a highly digital, modern world now, and over the last decade, a new contender has entered the arena: digital gold. But why the comparison to actual physical gold? It all comes down to this single hard-coded number: 21 million. Just like the absolute physical scarcity of gold in the Earth's crust, Bitcoin has a mathematically capped supply. There will only ever be exactly 21 million Bitcoins in existence, period. That fundamental scarcity is what drives the entire comparison. But here's the massive catch. Bitcoin is a high beta safe haven, and it requires absolute peak neurofitness. What do we mean by that? We mean Bitcoin is incredibly violent and highly volatile. During some global crises, it acts like a perfect, pristine safe haven. But in others, it crashes right alongside your highly volatile tech stocks. It offers potentially massive upside rewards for sure, but it requires an intense level of mental discipline just to hold on to it without panicking when the market inevitably drops. And comparing the two illustrates the massive psychological difference we're talking about here. Look at gold's nature. It's calm and slow, requiring very low neurofitness. You buy it, you lock it in a vault, and you sleep like a baby. Bitcoin's nature, however, is violent and volatile. The neurofitness required, extremely high. You literally have to have a stomach of iron to effectively use Bitcoin as your sanctuary. Which brings us to our final stop, Section 5, the architect's balance. Let's see how this all builds together. Your cognitive task today is to construct your portfolio strategically, not emotionally. Notice how a true architect doesn't actually choose sides in the gold versus Bitcoin debate. They use both. When we look at a smartly built portfolio, there's a very strict calculated slice specifically dedicated to safe havens. That's your gold or your Bitcoin, while the remaining slices are allocated for your risk-on assets. A master architect dedicates a precise portion of their SHEP to a sanctuary that actively thrives when chaos hits the broader markets. Because here is the harsh, absolute truth you need to hear today. If 100% of your wealth is sitting in risk-on assets, you don't have a portfolio, you have a bet. Seriously, if you're holding 100% crypto or 100% tech stocks right now, you are purely gambling. You completely lack the emotionless balance and strategic preparation of a true financial architect. So, we want to leave you with this final, highly provocative thought. Look closely at your own accounts right after this explainer ends. Ask yourself, are you building an invincible empire, or are you just rolling the dice? Stop acting like a reactive gambler, tossed around by market fear. It's time to start acting like a true architect, well before the next storm hits. Think about it.